Hi, good morning. We are going to talk to you a little bit today about cash management and also how to understand your cash flows a little bit better. As Tim said, we're with Cat Sapper Miller. My name is Brett Breedlove. I'm an audit partner in our specialty finance group. I've been with the firm for about 17 years and predominantly working with specialty finance companies, including buy here, pay here, and lease here, pay here throughout my career.
Will Claywell here. I'm an audit director at KSM. I've been with the firm about 9 years now. I've been working with specialty finance since I kind of started with Brett and others. And so excited to be here, excited to talk about cash flow.
So let's get into the agenda for today. We've talked a lot today and yesterday about the market forces in which we're in. We're going to take a few minutes and just talk about that in relation to cash flow and why we think it really matters today more so than ever to put focus and attention on your cash flow management strategy and your cash management plan. Then we'll have Will walk us through the foundational elements of the financial statements. Not all of us are created equal in terms of our ability to understand the financial statements and really what each one tells us about our cash flows. So we'll talk about that next. And then finally, we'll next go to talking about how to create a cash management plan, what that is, including a trend analysis, KPIs, and a cash flow forecast. And then hopefully we'll leave you with a few strategies to help maximize your cash efficiency from there. Okay, so the big idea here is that we would like to leave you with up front is a solid foundation of your past and present of your business in terms of your financial statements, your timely, accurate financial statements. That's really the foundation of understanding your business and your expectations for your future cash flows. So the financial reporting is such an important part of understanding where you're going and how you're going to get there from a cash perspective. So we've heard it a lot of times as we've gone through this summit that you can't manage what you don't measure, and your financial reporting process is really part of that. So, again, this summit, we've talked a lot about these concepts. Your baseline in this business is that your cash conversion cycle is long. And that makes managing your cash extremely challenging. That's really your baseline. Today, we have way higher borrowing costs than what we did 5 years ago. And that means that your cost in deal is higher. It makes your margins on, if you borrow to originate contracts, that makes your net investment in your leases, your long-term profitability and cash flow is going to be smaller with higher borrowing cost environment than a lower borrowing cost environment. So managing debt's really important today. We also have talked about entrenched inflation. And the reality is we have seen some cooling in areas of the economy in terms of inflation, but everything's really more expensive for both you all as dealers and your consumers. And for you internally, your operating costs, they've gone up. And your overhead is really a big part of your daily cash flow. And this just reminds us that we need to pay extra attention to our overhead to manage our cash flow. Externally, your consumers, it's kind of the same thing. We talked yesterday. We heard about rising delinquencies. You guys have all felt it. Repossessions are coming back. And really that's just a factor of inflation, and it makes collections and managing your cash through your collections department really important as well. The last one, talent came up a lot in this summit as well, and I'd be willing to bet that all of you, there's probably not one dealer here that would be willing to raise their hand and say they're just tripping over talent in every single aspect of their business. So we have a tight labor market. Tight labor market creates competition, and competition increases your wages. So that's a negative stressor on your monthly cash flow. So these are the environments that we're operating in that, cash flow management's important anytime, but I think these are factors that make it even more important today. So I'm going to turn it over to Will here. He's going to walk you through some financial statements.
When I start talking cash flow or thinking cash flow, there's two questions that come to my mind. I kind of want to know where I'm at today, and I want to understand where I've been historically. I like to understand those things with data, and I'm part of lawyers, I'm probably an accountant, so I look to see where can I get that information from. And the financial statements seem to be a great place to start for that. But there are some issues with most of the financial statements that get used or reported on a monthly basis when we talk about them from a cash perspective. The financial statements, normally they get used, the income statement, it's a measure of past performance. Now, when we're in a long cash conversion cycle, that past performance might not necessarily match to what's happening with cash, and we're going to talk about that. We also have the balance sheet. A lot of people use the balance sheet on a regular basis. The balance sheet is a measure of current financial position, and it gives us a glimpse into those future cash flows. But it still doesn't give us everything we need. So we have the statement of cash flows. We use those a lot. We prepare those on a regular basis for our review clients, audit clients. But I would bet that not many people do that on a recurring basis. That statement of cash flows is actually a bridge. It's going to help us get from the income statement and the balance sheet to what's happening in the business. So let's talk a little bit about each one of these statements. Like we said, the income statement, it's a measure of past performance. That measure of past performance is really a report card. And if we have a report card, we need to understand what we're being graded on. So, what does the income statement tell us? It tells us revenues, it tells us expenses, but are those revenues and expenses actually cash revenues and cash expenses? Sometimes, yes, sometimes no. The rubric that we're being graded on is normally GAAP, and GAAP focuses on two things when we look at the income statement: revenue recognition and the matching principle. Revenue recognition is really related to, if I have a contract with a customer, I'm going to recognize revenue when it's earned or when I've met my obligation to that customer. That could be when I deliver a good or when I provide a service to that customer. The matching principle tells us that we're going to try to take expenses and match them up to when we earn those revenues. Both of those things could tell us something about cash, but they also could leave us in the dark about what's happening from a cash perspective. And I think an easy way to see that is walking through the example of a deal. So if we have a buy here, pay here deal that's done, customer comes in, they sign the necessary paperwork, some cash down, walk away with the vehicle, drive off. In a buy here, pay here deal, the obligation that we need to meet is we need to provide that customer with a vehicle. Once we've satisfied that, they've signed the paperwork and left, we're going to recognize revenue then for that vehicle, and we're going to recognize the related expense for that car. We're going to have profit, revenue, and expense at that point in time. We flip it over to a lease, though. We have a same customer come in, they take cash, they sign the contract, they drive off. But in this instance, our obligation is to provide them that vehicle over a period of time, not to give them a vehicle to drive at the point in time. And so we're going to recognize that revenue in increments as we go, as they're making payments, and we're going to match that expense up by recognizing depreciation expense over the period of the lease. Now, in each one of those instances, the results that our P&L are going to show are different. We've got net income kind of on the front end with the buy here, pay here deal versus net income over time in the lease here, pay here deal. Our cash is the same though, right? That down payment's the only time when cash actually came in the door. So that the income statement really, though it's a measure of our past success or failures, it doesn't tell us everything we didn't know about cash. If we flip over to the balance sheet, first, what is this telling us? So the balance sheet is a measure of our financial position. We look at the assets we've acquired, we look at the liabilities we've assumed, and it tells us kind of how those items are going to turn into cash eventually, but it's a snapshot at a point in time. And to understand the balance sheet, we need to understand what all is on it. There's current assets and current liabilities, and there's long-term assets and long-term liabilities. These aren't all the same. Current assets and current liabilities kind of show us normally over the next 12 months what items are going to turn into cash. These are items, current assets are things like receivables, cash itself, inventory potentially. We've got current liabilities such as accrued expenses, accrued payroll, those types of items. And when you take a look at your current assets and your current liabilities and you smash those together and you kind of maybe take what you own and what you owe and look at that on a net basis, what you get is a kind of picture or snapshot, a glimpse into the future of what cash you might have or what cash you might need to come up with. But that picture is just kind of incomplete still. It's also worth noting that long-term assets and long-term liabilities, what those are and understanding those. In this space, normally what we see with long-term liabilities are really just debt obligations or lease payments into the future, so those are probably going to turn into cash at some point in time. We also see long-term assets, and those might represent future cash generators. Think about the leased vehicle fleet that you're managing. That's going to generate cash over time. But it might represent things that aren't going to turn into cash or that you've already spent cash on, such as property and equipment or intangible assets. And so the income statement, as we've talked about, doesn't always necessarily give us a full picture of cash. Neither does the balance sheet. But if we put them together with that bridge, the statement of cash flows, we can start to see where we currently are and where we've been. And how that works here, there's a formula on the up there. We start with our net income and our net loss. And we want to, that's a great beginning point for cash flow. But we need to adjust it for non-cash items. So we identify first non-cash expenses or revenues that are sitting in that net income, net loss. Think about the depreciation expense that you have. Think about the gain or loss on leased assets when items are taken to wholesale. Those items need to be adjusted from that net income because those are non-cash items. In addition to that, we need to adjust for working capital items that we talked about before. We talked about those current assets and liabilities and how they represent working capital and how those things turn into cash over time. And so those really represent accrual adjustments that need to be backed out or added to our net income and net loss to get back to a cash number. And when we've taken net income, net loss, we've taken our add backs, and we've taken the changes in working capital and combined all that together, we get to operating cash flows. And so that tells us a story about how the business is either using cash or how it's generating cash. And then from there, we need to step back and say, well, what other sources or uses of cash might there be in the business? And a lot of times what that is either debt service or capital expenditures, investing activities or financing activities. So I want to show us an example here of what that might look like. I know there's a lot of numbers on the page here, and so I just want to highlight a few things. First at the top here, you'll see a net loss here of $1 million. But if we look all the way at the bottom, we'll see an increase in net cash. And so how do we get from a net loss to an increase in cash? Well, as we're walking through and looking at the add backs that we have and the changes in working capital, there's one number that really sticks out. There's this $2.5 million here that was spent in operating activities. Looks like this hypothetical dealer that we created was trying to grow their portfolio, and so they bought a lot of vehicles, and they spent a lot of money trying to grow the portfolio. And so that turned into a big use of cash during the year for this dealer. Investing activities were minimal. They maybe bought some furniture, fixtures, but we come down here and we see that they really had the opportunity to borrow on their line of credit. And they used that cash from the line of credit to then fund the growth of the portfolio. Now, if we would have sat down with this dealer, hypothetically, and asked them what happened during the year, they probably could have told us that story. They probably knew what they experienced. But these numbers also allow us to see the same thing. And when you can take that over a period of time and stack those together, you can start to get a picture. Someone like me can get a picture of where has cash been coming from in the organization and where are we at today compared to where we used to be. And that kind of information can then be transformed or utilized to make decisions about the future. And I'm going to let Brett talk about that.
Okay, so let's talk about a cash management plan. Again, under the context of financial reporting, we believe that this really starts with timely and accurate financial reporting on a monthly basis. And so there's two key things there that I said, timely and accurate. So if you are in a habit of generating financial statements 3 months after the close of your business, that's not timely. That doesn't allow you to react to what's happening in your business. And then accurate, Will kind of talked about the balance sheet, and the balance sheet is the eventual how things turn into cash. And the balance sheet sometimes has what I like to call oldie moldy things that get hung up there that we don't pay attention to, and maybe don't have the ability to turn into cash. If you have an asset that's old and you can't convert it to cash, it shouldn't be there. And I think that accuracy of the financial statement and really scrutinizing all three of your financial statements, your balance sheet, income statement, and cash flow, is just really important to establishing a cash management plan and developing some future expectations. So, the other thing, if you get into a habit of 15 days after the close, maybe 30 days after close of your business of a month, being able to generate your financial statements, and that's balance sheet, income statement, cash flow, that starts to create a picture, a trend, as Will started to allude to. And that trend, if you can generate a 12-month trend, is what we recommend. That trailing 12 starts to give you a picture of what's happening in your business. And as that changes month over month, that trailing 12, that really gives you information in terms of what's happening to your cash, and is there something we need to react to. So, in addition to a trailing 12, I guess the other thing that we would recommend, so establishing that trailing 12 month and just really timely, quickly producing that on a monthly basis, we recommend that you overlay your metric system, particularly your KPIs that are really tied to what moves the needle in your cash. We feel like those two things together form a really nice detective control. It allows you to react when things happen in your business. So, your KPIs are a key piece of that. It informs. I think yesterday, maybe it was yesterday in one of the sessions, the KPIs that are tied to cash, that helps you communicate to your leadership what's really important and how you're trying to press on cash management and how you're trying to improve your cash flows. It allows your leadership to manage to that too. But then your KPIs, they also are really effective in developing dials in your cash flow forecast. And we'll talk about a cash flow forecast, but that's really taking your past and extrapolating that based on your assumptions in the future into what your future expectation of cash flows are going to be. This allows you to get out in front and be way more proactive with a 12-month cash forecast. So, in here, cash management plan, so your trailing 12-month, we think that's important. Overlaying your KPIs and what are your monthly metrics that really tie to what moves the needle for your cash flow. And then using both of those as your detective controls and your proactive preventative control is really that 12-month cash forecast. So, those are the three pieces, I think, and those moving together really help you give a nice picture and help you plan for your future and align your strategic operations or your strategic opportunities. The last thing here that we'll talk a little bit about, and we'll go into detail on all of these a little bit more, is just, once you've really developed a cash flow plan, you've aligned those with your operational goals, your strategic initiatives, just really, being able to take a step back and taking a look at your incentives as well and making sure that that supports what you're trying to accomplish. So we had a session on KPIs. I didn't know that before I put this together. But I do just want to point out a couple examples of metrics and your metric systems that we feel like are really tied to your cash efficiency. And, on the inventory side, we talked a lot about, your average reconditioning time, your time to line, and getting your vehicles ready to be revenue producing. So from the date of acquisition to the whole time you're reconditioning your vehicles, that's time that you've either expended cash or borrowed, and that's not able to earn any revenue until you've moved it off the lot. So, if you have an ability to track monthly and measure what your time to line is. And if you are at 6 weeks today and you can move it to 3, that is just exponential in what that does to unlock your cash flow, helps you reduce your debt, save some cash on your debt service. So we feel like that's an important one. Another one that was talked about, I think it was brought up yesterday, but just the days sales. So, this is really a measure of how much inventory you're carrying in terms of the months of originations, the originations that you have in your portfolio. So if you have, 6, 7, 8 months of originations in your inventory, you're probably really heavy, and you have an opportunity to reduce your debt, shrink your inventory levels to something that supports what you really need in your business. And so this is just another data point that helps you manage your cash flow. This next one, income and expense per deal. This is a little bit more of a manufacturing concept, but I really like taking your overhead, your operating costs, and dividing that by the number of contracts you have monthly. And, particularly we talked about scaling, and, when we have clients that are scaling or growing, or maybe the other side, maybe they're trying to right size for whatever reason and shrink their business. This is a really nice measure that helps you determine if you're doing that cash efficiently. So, being able to break it down, your overhead costs of your business by a per contract, if you're growing contracts, is that ratio going up faster than what your contracts would support? That means you're probably not being very efficient in your scale, and allows you to create some action around that. In terms of collection metrics, yesterday we talked about cash efficiency, just the average, some type of measure around the average collection payment collected per customer per month. That's a measure of your cash efficiency, how your collections are working. And what I also like this metric for is when you get into your cash flow forecast, if you guys aren't budgeting and forecasting your cash flows into the future, that metric is really a nice one to track over month over month, because this really allows you to develop that dial, that assumption for future months in terms of if you're going to grow 20 contracts a month, what does that give you as an expectation of how much cash flow is going to come in? So that metric really feeds into your cash flow forecast. The last one here, you all are monitoring your delinquency super close. You pay attention to this all day. What we see in our client base sometimes is some of the miscellaneous receivables. So I just wanted to call this out while I had a chance, the stage, if you will. Oftentimes it's the side notes, it's the miscellaneous receivables that tend to start really small on your balance sheet. They tend to grow without people really having their, your leadership teams having their eyes on that balance sheet. And then all of a sudden, those assets have gotten really old and they're really hard to collect. So I think the only thing I really wanted to call out here was just, pay attention to your balance sheet, scrutinize them. If you start to see side notes swell, it probably means we've got a collection issue, and that's really cash you're leaving on the table. Okay, so we're going to talk about how to build a cash forecast here in a second, but I really wanted to highlight for those who aren't doing a cash flow budget, a 12-month cash flow budget, really the benefits of getting there. And I think first and foremost, again, it allows you to be proactive in your business. There are ebbs and flows in your business. You're going to have really great months where you collect a ton of cash, and you're going to have others that you don't. And a cash flow forecast, if it's accurate, gives you a 12-month look into the future to determine which months are you really nervous about, which months do you have cash shortfalls that you're projecting, and what are you doing in advance to prepare for that? Are you stretching your payable terms to build up some cushion? Do you have the availability in your line? On the other side, if you have months where you have a lot of cash surplus, if you're getting cash in the door net for a series of months, what investments are you making in your business to generate future returns? Or how are you minimizing your debt and saving money on your debt service? I think another benefit also here is, for your leadership teams, if you've got a 12-month forecast, you all are setting priorities in your business. You're trying to determine how you're going to scale, how you're going to grow, really what you're going to press on for the next year. A cash flow forecast really allows you to reality test that a little bit. So you may look and wake up one morning and say, the headwinds are gone. We want to grow 50 contracts a month. You may model that, put that into a cash flow forecast, and you might realize in 4 months you're out of cash, and you're not able to grow. And maybe that cash flow forecast says at 20 deals a month, that's sustainable for 12 months. We're going to have meaningful growth without creating a cash pinch. It's way more advantageous to get in front of that 4 months in advance. That gives you time to deal with it, talk to your capital providers, figure out other strategies to maximize your cash elsewhere to give you the room for the growth. And it's better to deal with that up front than dealing with the crisis when it happens. I think the last thing, just a point to your capital providers, I also think this cash flow forecast, it conveys some confidence to your lenders or other capital providers. When you go to them with a plan, this is what we're trying to do in our business, if you're able to lay out how that's going to impact your cash over time, that instills a lot of confidence that you have a plan, you know what you're doing, and it allows them to be part of the ride to talk about how they're going to help in growing your business or achieve whatever operational strategy that you're focused on. All right, so let's talk about how to build a cash flow for it. My goal today, by the way, was to not put any spreadsheets in here because I know that's what accountants tend to get judged for. So I thought a picture might help, but I do have a spreadsheet after here that we're going to look at. Just one, though, I promise. So to start a cash forecast, you really want to start with a 12-month actual. So the same concept, this trailing trend. Develop 12 months of your actual sources and your uses of cash. That's your starting point. That's really going to be the baseline of how you're going to extrapolate those into the future. We recommend categorizing your data when you lay it out so your sources feel easy, rental payments, upfront down payments, and wholesale. When you get into your operational uses, really focusing on breaking those into core categories that you can manage and you track already through some of your other budget models, but then also sorting them into fixed and variable costs. And the reason why we recommend breaking into fixed and variable costs is that your fixed costs, they're highly predictive. You don't need to do a lot of work when you're extrapolating those into the future. Occupancy would be a really good example. Your monthly outlay for your rent is predictive. There's not a lot of work here. Now your variable costs, on the other hand, those uses of cash, those are the items where you really need to develop an estimate. You need to come up with a driver, a dial, if you will, and an assumption that allows you to scale your expectation for cash flows in the future. So let's give an example. So payroll might be a really good example here. That's a variable cost. It depends on your headcount, and you may decide in 3 months in your growth strategy that you need to add 2 collectors. And so coming up with a dial in your assumptions for your variable uses on your forecast, that lets you take your assumption of maybe average payroll per employee and account for 3 months from now when you add 2 collectors, what that's going to do to your cash flows. So your variable uses, just again, the key point here is just those are the ones that each one of those you're going to have some type of assumption, some estimate that you make that you can extrapolate into the future. So once you get there, you've kind of sorted, you've categorized your buckets, you've developed assumptions for your sources and your variable uses, then you're really just plotting it out and you're taking 12 months. We recommend a 12-month cash flow. We have clients that do longer. I've seen a 3-year cash flow forecast. I think after 12 months, it gets really, really foggy and maybe hard to count on and maybe hard to make decisions from. But 12 months is really that sweet spot that allows you to make decisions and be proactive about what you're going to do in your business. Last piece here, just in terms of reviewing results, always reality test your cash flow forecast when you build it and compare it to your prior 12. And if you have a cash flow forecast that just looks great or really bad relative to historically where you've been, that's usually your key to go back into your model and see if you've got your assumptions right, your math work makes sense. Okay, so I promised one spreadsheet. This is it. This is a super simple, high-level example of what a cash flow forecast might look like. Now, get my pointer right. This column here, imagine to the left of this, you have your actual data. So your trailing 12 would be to the left of this. In column 1 here, that's really the start where you're looking at your sources on top, rental payments, wholesale cash source, and then also upfront your down payments. Then you have your operating uses, and again, splitting by fixed and variable. Your fixed, rent, insurance policies, subscription agreements to technology that you're utilizing would be another example. Those you usually get 12 months of an expectation. What's your monthly outlay? You know what those look like, not a lot of math or thought. Your variable expenses, reconditioning per vehicle. You'll need to develop an estimate around that. Your personnel costs, again, what's your head count? What are you expending monthly on a per employee basis? Those are assumptions that you'll need to build into so you can plan for if you're going to add 20 vehicles a month, or if you're going to add 2 personnel in 6 months, you can really build that into your future cash flow. A note here, just make sure for investing activities, if you have any planned capital expenditures, make sure this is included in your cash flow forecast. This is, we have so much focus on operationally and your daily cash flows, but if you know you have leasehold improvements or you need to invest in a piece of equipment or something, baking this into your cash flow forecast is really important, because you might get to a point where you have months and months of surplus, and your decision on whether or not you're going to finance a portion or all of it, or maybe you have the excess cash and you're going to invest in that property through your own cash flow. This helps you model that and how that impacts your overall end-of-year cash number. Last piece here is just on your financing sources. If you do have fixed debt, making sure that you are plotting your monthly principal and interest payments on your debt service there. So you kind of get to this column where you have your sources on top, your fixed and variable operating costs, and then this marries up to what Will showed you earlier. You've got a net operating cash flow or use presented there. Same thing with investing and financing, and you get down to this change in cash. And what we see mostly with our clients who are doing this well, if you use leverage, you have a line of credit, this is really the area that you might take your surplus or shortfall and either treat it as a repayment or a borrowing from your line of credit. And once you start doing this on a monthly basis and rolling, that allows you to look out 12 months at any point in time, what is your anticipated debt level? And then you can compare it to your availability. Do you have an issue? Do you have any months where it's going to be really tight? And then what are you doing with that? Are you stretching your payables? Are you renegotiating some terms? Are you downsizing where you have extra meat? Just how are you managing those periods there? All right, so last piece for me, again, so you have strategic priorities that you are all hyper-focused on. You are establishing your metric system. You've got a trailing 12 that's going to inform you about monthly just what's happening as you execute your operational strategies. All of those things are moving in the right direction. And what we see oftentimes with our clients, or at times with our clients, is that they don't take a step back. Once all of that's moving in the right direction, you feel good about your cash flow plan, how it aligns with your operational goals, just what that means for your incentives and your employees. So your incentive system, your personnel are the people that are going to really drive the change. And if you're focused on something to change your cash flow situation, do your incentives support that? So I wouldn't recommend going home after this and blowing up your incentives. But just 2 examples here, maybe to illustrate a point. Asset creation, if you have sales incentives today that are just unit-based, or maybe it's based on the agreed-upon value of a lease contract, what if your sales incentives instead were more tied to asset creation? So tiered scale of risk score. So if you're doing risk scoring and you pay a higher commission for a really good deal and a lower commission for an okay deal that you're still comfortable making and putting on your books, that asset creation, putting a nice quality contract on your books is going to be way better for your cash flow than an okay deal. And so if you change your incentives to focus in on how to create cash flow by better assets on your books, and if you create training around that of how you can take an okay deal to a really great deal, maybe $500 down up front, an increase in your up front, maybe that makes an okay deal a really great deal. And if your employees get to share in that, that's just going to be better for your long-term cash flow there. So just that's an example of just how you can maybe look at your incentive structure and how do you tweak that to support what you're trying to do from cash flows. And then the last one I'll leave you with is just, if your focus on cash flow is going to be around inventory, you want to shrink your lead time, just again, making sure you're focusing on your incentive systems. Does your service center have the right incentives in place that are going to really press on that lead time and cause and drive actions there? So I'm going to turn it over to Will if we've got some time, and he's going to take us home here. Maybe. I don't know if that's working.
So if we have an understanding of where we've been, if we have an understanding of where we are, and we've got a plan where we're headed, the kind of final question that comes to my mind is, well, what else can I do from there? And here's some options of strategies you can look to implement. Some of the stuff's already been talked about. The first one that we'll talk on is tax planning. Good tax planning looks to delay that tax obligation into the future so we can respond to it. But delaying that payment on taxes also delays having to pay cash for what's going on. And so effective tax planning can actually be a helpful tool when you're looking at cash flow. The other one that, well, before I get into the rest, this normally inserts the question of, okay, we've had bonus depreciation at 100% for years now. What's going on from there? And so I didn't want to miss the opportunity to just kind of speak briefly on bonus depreciation, even though we're talking cash flows. We're at 60% for 2024, and it's going to phase out by 2027. So there is kind of a challenge there as bonus depreciation goes away that people are trying to solve for, and we're getting questions from clients on how are we going to address what's going on. 179 is an option. It's similar to bonus depreciation in the sense you get to expense those assets you've acquired, but it does have limits on it. You have to be a taxpayer in order to take advantage of 179, and so if you aren't a taxpayer, then it's not going to be an option for you. It also has limits on the amount of vehicle purchases that you've made or total purchases that have been made. So up to 1.1 million of purchases, you can take advantage of 179, assuming you're going to be a taxpayer. Once you get above the 1.1 million, it starts to phase out. And then once you've hit 3 million of purchases, it's no longer available. So if you're buying a lot of inventory, 179 might not be an option for you either. And so another thing, which there was a great session right before this talking about reinsurance, and one of the big keys that people kept hitting on was the tax efficiency of reinsurance. And so we're telling our clients the same thing. It's like, where do you have opportunities to either add that additional revenue stream or offload a risk that you already have in a tax-advantaged way? They touched on a lot of this, but there's definitely considerations about the cash flow impact up front when you're starting reinsurance. And so you want to make sure that you're choosing the right products and you're doing it in the right way, that it doesn't make the cash flow, if you have a cash flow problem, make the cash flow problem worse. But in the long run, it really can be a source of capital. It can be, people talked about real estate and buying real estate with it. Doing reinsurance the right way can actually be a real tool to the business and create a space for accessing money to go do other things. So that's a huge opportunity, both on the tax planning side and just in kind of long-term building wealth. So the other thing to kind of consider, this goes, I'll use Brett's example of service and inventory, but looking at vendor terms and looking at making sure that those are aligned is something to just kind of consider as you're going through the process. If it takes the 6 weeks that he said to kind of go from purchase of vehicle to getting a customer paying on that vehicle, but we're having to pay for the reconditioning we're doing in 30 days or 45 days. Well, we're going to be paying a lot of reconditioning before we're actually getting money into the business from customers. And so just making sure that we're getting the best and most advantageous terms with our vendors and looking at that as things are changing as well. It's a good forward-looking strategy to kind of use. And then finally, the last one there, that access additional capital, that really goes back to what we talked about with reinsurance there. That's a great example of that, where can we use money that we have? Do we want to invest in the business through our own finances? Do we want to find something like a reinsurance product where we can maybe inject money into the business to continue to grow and to continue to achieve the goals that we have?